Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and we're joined today with a very timely guest. We've had a lot happen here in 2020. I think if you were to hear in hindsight, if you were in 2019 and someone was to tell you, man, we're going to have a 3 billion person global lockdown, trillions of dollars thrown at the system, millions of people going on unemployment, I mean, you would probably have some certain expectation as to what you would expect to happen. And maybe it wouldn't line up to what we are seeing right now. But regardless, we have John Williams of Shadow Stats on the line. He's someone who really pulls back the curtain on what is going on with the real numbers and how they were done in the years past, because we know that through the years they massage these numbers to create the illusion of a better scenario than we really have. So without any further ado, John, thank you so much for coming on Crush the Street with me once again.
Well, thank you for having me, Kenneth.
Well, like I said, I want to cover 2020, cover stocks, money creation, unemployment, and the fallout. Let's start with unemployment, something you cover very closely, jobless claims. I mean, we were at around 45 million jobless claims from the start of the coronavirus until recently, and that's just under 30% of the 160 million person workforce. So let's talk about, the blow this really is having on the economy. Maybe you can break down those numbers a little bit.
Sure. Well, the problem is that where we've had this coronavirus shutdown on the economy, it has disrupted more than the economy. It's also disrupted the government's gathering of economic statistics. They showed the unemployment rate peaking in April and then coming down in May and June. But based on the unemployment claims, I don't think it came down in May. It may have come down a little bit in June, but we're looking at something here which is really is a bit beyond the scope of anything ever seen before. The shutdown of the economy largely hit in March in terms of the economic numbers, and where the GDP, for example, is measured on a quarterly basis, you had 2 months that were reasonably normal. You're starting to see some impact in February, and then you got the first real hit in March. That hit in March was enough to knock the official first quarter GDP negative quarter to quarter. First time we've had that since the Great Recession. And actually, it's back. We had a negative quarter back in the mini recession of 2017, but it was the biggest hit since the Great Recession. And now we're in the second quarter. We've actually completed the second quarter, and in a couple of weeks we're going to get an estimate of the second quarter GDP. So we're down about 5% in the second quarter. In the first quarter. The second quarter is going to be down, as I'm estimating it, about 50%. That's an annualized pace. The consensus is around 35%. But to put that in perspective, if we have a 50% decline, that would wipe out all the economic growth since the Great Recession, all the recovery since the Great Recession. And in any event, if it comes out of the consensus, it's still the worst quarterly number ever seen. And it's because what we're seeing here is an absolute economic collapse that was not triggered by normal economic factors. So I'm reluctant to call it a recession. The way they used to define recessions, usually it was driven by economic factors. But if they had an unusual extraneous event such as a trucker strike, they wouldn't call it a recession. I don't think what we're seeing here really should be called a recession. It's really an economic collapse driven by a pandemic or pandemic-driven collapse. And so what you've seen is an economic collapse with a government shutdown that maybe will hit its trough in the second quarter as we see it reported. But as it hit the employment, people were just laid off. You saw a record jump in unemployment. The government's reporting, as I said, was heavily disrupted. They're not. I don't think they're quite sure what they're reporting. If you look at the last numbers, the unemployment rate, the survey response was down to 65%, where normally it's up at around 83%. And that's not an environment where you can count much on those numbers. Aside from that, and the Bureau of Labor Statistics was very open on this, they were unable to adequately count and record the unemployed. At one point, and I think it was in April, there were 7.5 million people counted as employed who were really unemployed. And that was per the Bureau of Labor Statistics. So at one point they're reporting an unemployment rate of around 13-14%, but really it was up around 19%. That's their number. If you take my number, and what I do is I estimate unemployment the way it used to be before NAFTA and a redefinition to the series back in 1994. Back in 1984, coming into 94, if you couldn't find a job but you'd given up looking for work because there were no jobs to be had, you were counted as a discouraged worker in a broader measure than the headline unemployment, which they now call U3, unemployment rate 3. That's the U3 is a headline unemployment, but as a result of the redefinition at the NAFTA time, where before, if you were a discouraged worker, you could be a discouraged worker as long as you wanted a job and were not actively seeking one because there were no jobs to be had. You'd be counted as a discouraged worker. They redefined that with the 1994 overhaul so that you were only counted as a discouraged worker until you were a discouraged worker for a year. And if you're a discouraged worker for a year or more, you're no longer counted as discouraged. I saw that as a really bad political gimmick, so I continue to track it. And where the government numbers got up to a peak of 19%, using the actual numbers as the Bureau of Labor Statistics indicated. So, yeah, we have an issue here, we've got a problem, but because the survey's been finalized, we never go back and change the survey. So we're not going to correct the numbers, but here's what it would have been had we had the correct numbers in hand in the survey. So where they got up to just shy of 20%, my number got up to 40%.
Wow.
Now it's come back down. You're looking at something in terms of the headline numbers. It's I think it's up around 8-9%, maybe a little. I don't remember the exact number. Mine is up around 30%. So that's an uncomfortable position for many people.
Absolutely. Well, I mean, if you look at just the amount of people that are filing jobless claims, I mean, it really starts to line up with your numbers versus the government ones. And so, yeah, go ahead.
So that's a problem because as long as that was increasing and the ongoing claims were increasing, what that indicated was that generally the people were still net losing jobs and the net unemployment rate should be going up. But the net unemployment rate started coming down. So the numbers are not of good quality, but I can tell you that what we have seen, and what we still have in place is the worst unemployment circumstance ever seen. This is worse than the Great Depression as best estimated.
John, do you have any idea of who's getting hit the hardest with your statistics? What type of jobs, let's say, are being hit hardest? Is it low income, high income, maybe the industries they're in, government versus private? I mean, anything that would just shed some insight on what is going on and who's being impacted by this the most?
Well, the people, it's hitting across the board. I mean, I know a number of small businesses that have shut down. People have gone out of business. Those are self-employed people. But in terms of the headline numbers, it's very telling. Again, if you go back to what the government's reporting as sort of the peak unemployment in April, in that month, the same time that the unemployment rate is surging, what happened was that the real monthly average earnings soared. It's up 7%. Wonderful gain. The only reason you saw that was not because a lot of people were being hired, but the people that were being fired were the lowest paid workers, so that the average earnings skyrocketed as the guys on the lower rung of earnings were fired or laid off, and so a lot of that was in the leisure and hospitality area as they break it out in their numbers of casinos and such. Now, where they've shown some numbers coming back as they gained some employment in the headline numbers in May, and I guess basically in May, you saw the average earnings drop some, and the jobs in the leisure and hospitality began to. That's where you had the biggest gains, and you had some of that in June as well. In May. You have June. But the unfortunate thing there is that there's a lot of evidence that the elements of the economy, that some of them that supposedly were reopening, never got fully reopened, and they're now having problems, and they're shutting down again. The casinos. It's a big area in that recovery, the headline recovering numbers. So I don't think you're going to see particularly good numbers in the next month or two in terms of the employment and jobs gain. There'll be some, but it'll tend to be below expectations. And if there's the recovery here,
right?
Keep in mind that what happened to the economy was it was just shut down. It wasn't that people weren't making money and couldn't go out and buy goods the way they used to. Although that coming into the downturn, coming into the economic collapse, that was very specifically the pandemic shutdown. The economy was already slowing down. You'd had fourth quarter and the fourth quarter real retail sales contracted. That was your holiday shopping season. That's fourth quarter of 2019. So the economy was already slowing down. This is not any consideration about a recession last year out of the ballpark. No one's ever seen anything of this magnitude of an economic downturn. But as you look at the numbers and what's going to be the worst, Fed Chairman Powell says we're going to see the worst GDP ever in the second quarter. Indeed, he's right on that as best I can see. It's not a standard contraction. It's an artificially induced economic collapse. The recovery from it is tied very specifically to the pandemic. The downturn, the shutdown was due to the pandemic, and to get a normal rebound here, to get the economy going again, it's not a matter of how much money you spend to stimulate people to buy goods. It's how you get the pandemic under control and can get society back to a normal functioning.
Right.
And if the society went back to normal functioning now, you'd still see something well shy of what would be normal economic activity because of the damage done with the initial shutdown and the damage that is still happening and the difficulties that people have been having in getting this economy reopened up to this point in time.
It's not equal and opposite. They shut this down, and there's damage that was done to get back to where we were at one point. Now, in that same vein, without stimulus, doesn't this get worse? And I mean, speaking to the unemployment rate, would the unemployment rate actually be higher if it wasn't for the PPP? Or, and I'll throw this at you as well, were unemployers more likely to lay people off because of the government safety net? They felt like, oh, okay, well, we have the government to take care of our employees, so we're gonna just allow that to happen and not feel the burden of responsibility
Well,
to keep them.
certainly there were people that used it that way, but let me put it this way: if you're in business, you're in business usually to make money, and if you can keep your business going, if you can continue to make profits, that would be your preference. So I think where people shut down, it was because they really had no choice in the matter as they viewed it, either by government mandate or they're just saying their business is drying up.
Right. So going back to the money creation, and I love your analysis on this. This is something you follow, the inflation rate. But as it pertains to overvaluations in real estate and the stock market, I'd say the money creation is one of the biggest caveats to the overvaluation that many people are seeing in real estate and stocks. And for about 60 years, we know that the M2 money supply has grown at just under 7% annualized. And this also happens to be really close to the return in the overall equities and real estate over the same period of time. And it does seem like we're in a period of extreme disconnect between fundamentals of stock market and real estate, but it's also being thrown off by the money creation. And can you just shed some light on this? Because I don't know how much longer we can go on for where we're just discounting companies' future revenues for decades down the road, or maybe no revenues down the road, just because there's no other place to go, and people feel like the stock market is the only option.
Well, the stock market is the last option I'd look at personally. I think you're headed for a tremendous collapse there. Underlying fundamentals could not be worse, other than the Fed is pumping extraordinary amounts of money into the system, as is the federal government. And but we've never, where the pandemic shutdown is unprecedented in terms of its scope and the damage to economic activity, the Federal Reserve and the federal government have given up any sense of containment. They're just doing everything they can to try and keep the system afloat. The Fed is creating whatever money it has to. And there's a tip-off there. One thing I've never seen before is that I don't think anyone has, as a crisis hit and the Fed starts saying, oh, we'll print whatever money we have to print, they also eliminated the reserve requirements for banks. Now, reserve requirements were there for a generally good purpose, and that is to keep the banking system in control and solvent. The idea of a reserve requirement was, the banks, the people deposit their money with the banks. The bank then lends that money out to the public with a certain ratio, but they have to keep a certain amount in reserve in case some of their loans go bad. And if the loans go bad, the reserves are there to cover it, so the bank doesn't go under. So they just went to zero on the reserve requirements. Never seen before. This is at the same time that the Fed is just opening up its pumping up money supply in a way never seen before. We're shy still of 40% year-to-year growth now in M1, which is the narrowest measure. It's up in the range of 25 to 30% if you look at M2 and M3, which is I still measure, but no one's ever seen anything like that, at least in the United States. That's at the type of levels that will tend to trigger inflation over time and give us a very serious inflation problem. The federal government, forget any concept of having a balanced budget or trying to restrain the deficit. They're creating whatever money they have to, or whatever spending they have to have. No limit on the deficit. It's not, the deficit wasn't sustainable before. You're coming up to a point that you could be facing effective insolvency of the United States not far down the road if you keep going at this pace. between that and what the Fed's doing, we've got a real major inflation problem ahead of us here. And the traditional stability for people in that type of circumstance is to hold physical gold. But we're going to see political turmoil. We're going to see financial market turmoil here. The real estate prices may seem out of whack, but real, the term real there refers to the inflation. Gold, silver, actually real estate will hold its value over time against inflation, particularly a bad inflation. The difference between real estate and gold and silver is that the real estate generally is not it's not portable and easily liquidated. So that's why the precious metals are really the best store of wealth, I believe, in this particular circumstance. But again, I'd take physical possession here, because what you have is an unstable circumstance, and where it goes is anyone's guess. I don't see the times as being good, and I sure don't see them as being happy for the stock market.
Absolutely. Well, yeah, that's an interesting point you bring up about real estate. And if we do go into an extended downturn with real estate, you can imagine that a lot of real estate developments might go on hold. And we saw what happened in 2008 following a real estate crisis. The supply over the years has been down for many people in many areas, and there's a shortage that a lot of the realtors talk about. And so that would be really interesting if we do go into another crisis and there is an ongoing shortage of real estate with an increasing amount of people. It does make sense that it would hold up better than stocks in general. So interesting points there. And kind of circling back to what your thoughts were on the GDP collapsing by 50%, and in line with stock market overvaluation. I mean, we're in a situation now where the stock market is 150%, 70% higher than the current GDP. That was not always the case. I mean, at times it was 20 to 30% of GDP, but stocks now are so much bigger than the global GDP, or the US GDP. And so if we see a collapse officially of this 50% GDP, I mean, what's that going to mean for stocks? Do you think stocks are just going to continue to just stay up at these overvalued levels, or is there going to be a real shock to the stock market?
Well, first of all, the GDP is or the big hit there is already anticipated. Again, the consensus is for an annualized 35% drop. I'm looking for a 50% drop, but it's not as though you're going to go down 50%, down 50%, down 50%. The biggest hit here is going to be the second quarter, which will be reported at the end of this month. And if indeed the bulk of the damage has been done and we're at an economic bottom, and there might be some hope of that, but I don't think so. I think we still have some issues ahead of us, but you're not going to see another 50% drop. You might see some bottom bouncing. It might be down a little bit. It could be up a little bit. Once you hit bottom, and we're probably coming into a bottom the second half of this year, any growth to the plus side is positive growth, and it can look very dramatic. I mean, it could be up 5%, which would be a wonderful GDP growth, but you'd still be down 48% or something from where you were the year before. It's going to take a while for this to come back, but it's hopefully we'll see some positive growth going forward. The stock market, I just don't see it having any real basis in valuation here. That's been a common circumstance. You've got a lot of people that love to manipulate it and do their best to keep the market up, including the Federal Reserve and the Treasury Secretary. administration. Is what they put the plunge protection team in place back in after the '87 crash. Called the President's Working Group on the financial markets. And if you go back to December of last year, this is before the pandemic, the Fed, I'll put a lot of blame here in terms of the underlying fundamental issues with the Federal Reserve. The Fed mismanaged, and in fact, I'll say simply malfeasance in terms of what they did with the banking crash in 2008. I think in many ways they would have done better just to let the system, the banks that were failing fail and restart a system, and rather than spend all their effort and all their capital to refinance and bail out people that, from what I could see, shouldn't have been bailed out, and banks that were misled or got into trouble while they were under the guidance and the tutelage of the Federal Reserve. I know a lot of the problems that went on there, and a lot of the problems can be laid right at the foot of the Fed. Nonetheless, the Fed bailed out the banks, and at the expense of fully bailing out the U.S. economy. Their concern was the banks. So in all this process and all the money they put in to prop up the banks, the economy began to come back. And with the economy coming back, they said, aha, all the money that we put into the banks, now maybe we can start to tighten up the liquidity and move back to maybe where we should be in overall financial shape. And as soon as they did that, of course, what they did in tightening the liquidity and raising interest rates was to hit an already fragile consumer, and it was actually driving the economy into a new recession at the end of last year. You had a stock crash in December, right at the end of the year, because the Fed was raising rates, and we're going to raise rates again into the next year. People are already seeing the economy fall apart with that. So the markets crash. They bring in the plunge protection team, get the stocks back up. The Fed's all of a sudden cutting rates. We're not going to raise rates further. And then they start cutting rates, and then as you come in just before the first quarter, before getting to the coronavirus, all of a sudden you're seeing these big repo agreements that are providing liquidity again to the banking system. Banking system's in trouble again. And of course, then the coronavirus hits and system shut down, and the Fed goes into infinite money creation as needed to support the system, support the banks. And I don't see where this has a real happy ending here for the economy over the next 5 years or so. But I would hope that there would be some reorganization of the banking system and the Federal Reserve as a result of this, because the Fed is not handling things well. They will do everything they can to keep the stock market up, and you want to have the stock market high. That keeps people feeling good, and people have increased wealth, and they tend to be more positive about things going forward. But I'd see it as being extraordinarily artificial at this point in time.
Absolutely. And you just said something there that I think is so important. The stock market keeps people happy. The headline numbers, the Dow Jones, the S&P 500, they seem to get the most attention. But what's interesting is the bond market significantly dwarfs the stock market. And I'd like to shed some light, if you would, how, maybe you can articulate this, how dependent the world is on a functioning credit market, the bond market, from pension funds to retirement, and the caveat being, how vulnerable the bond market is, and that, people don't really understand it. People look at the stock market, they think that's the barometer for everything, but I think the bond market is really where people should be focused as well.
Well, the problem is the system's insolvent, and everything what the Fed's done to bail things out, and what the federal government's done to bail things out, we're looking effectively to bankrupt the United States and a bankrupt Federal Reserve. I don't see this coming. I don't see us coming out of this without a very major inflation, something akin to a hyperinflation. And with that, right now interest rates are zero, so you don't have a functioning financial system. You do not have a normal bond market. There's nothing normal about the current financial markets. Are very heavily rigged and controlled by the Fed, and you have a circumstance where as we head into a hyperinflation, which I think is where we're heading, stocks may soar in that, but they're not going to be worth anything. The growth in them will be inflation, not in real value. With bonds, there are all sorts of issues there, but generally it's the entities that will be paying below the money generally are not going to be solvent. This is a time to batten down the hatches, and I would put an increasing portion of my assets in, again, physical gold primarily, silver as well. Those are hard assets. They'll ride out the time, and what I found early on, if you go back to the Nixon closing the gold window back in '71. Up to that point in time, gold and inflation had pretty much stayed tied together. After that, you start to see the U.S. headline inflation beginning to go up, but gold prices are going up even faster. It is, we get into the 90s, the government didn't like the way the inflation numbers were going, because the higher the inflation, the more they had to adjust cost of living adjustments for Social Security and such. So they started to rig the unemployment numbers to depress them. They're not the unemployment numbers, the inflation numbers. And again, that's something I tracked, and I have an alternate measure which puts back the inflation the way it used to be. And the interesting thing is that if you look at our inflation corrected for the artificial depressants that the government put in, it has kept right up with gold, or gold rather has kept right up with it. And gold actually tends to lead the inflation numbers. What you're seeing now is an uptick in gold and silver prices. I take as a leading indicator of some serious inflation ahead. A lot of people are looking at the problems there, and that's why there's a leading relationship. And over time, gold will protect you against inflation. Real estate will as well, but again, it's not portable and as easily liquidatable as the precious metals. So everything else that gets blown up in prices, my goodness, we can have, depending on how you count the inflation in the GDP, and that's one reason the GDP has been as strong as it has been in recent years, because they tend to understate the inflation. And when you look at inflation-adjusted economic growth, the lower the inflation rate you use, the stronger the inflation-adjusted economic growth is. What some of the growth we're going to be seeing here in the economy going forward, and certainly in the stock market, is going to be based on inflation, not net of inflation. And if you're an investor, you want to look at your investments and your assets from the standpoint that hopefully they're going ahead of inflation, because then the value of your assets is increasing in real terms.
Absolutely. Well, and it goes along with Ray Dalio's headline that he, plastered the internet with, which was "Cash will be trash." If stock market going up in dollar terms is not a good investment, imagine what holding cash is going to be like. So I guess with that, John, maybe give us some closing thoughts, and also I want to appreciate you for coming on the show and sharing your time and your wisdom with us. Let everyone know, if they visit your website, where they can go and what they can expect to find.
Sure. Thank you. My website is shadowstats.com. And you go to my site, you see the opening page, right-hand column. I post whatever the breaking news is on the economy within a couple of hours of new numbers coming out, and I'll give you a quick analysis of those numbers and anything really unusual in them. Look at the left-hand side. You see a long list of my commentaries, which go back to 2004. Any commentary that's over 90 days old is available, no charge there. Of course, if you'd like to subscribe, you can, for $175 a year, you get live commentaries and access to everything. But there are other things on the site as well. If you want to see the alternate inflation numbers or the alternate unemployment numbers, they're available there. Just click on the alternate data tab at the top of our page. It explains how they were derived and shows you at least graphically where they are at present. Always welcome visitors, and certainly always welcome new subscribers. And in terms of where we are right now, the key risk I see is inflation. I don't see any real chance of the Fed getting out of this current circumstance without that, and certainly not with the federal government spending the way it is. So what you need to look at is, to the extent you can, is to protect your assets in terms of real value assets that'll gain on inflation, or at least stay even with it. And the best I know there is gold. Physical.
John, thank you so much for your time here at Crush the Street. You're really appreciated, and especially in a time like this, to kind of really go over the 2020 year. My goodness, what a treat that was. So thank you so much.
Thank you again, Kenneth, for having me.